For more, let's welcome in Jeff Harte. He's senior research analyst at Piper Sandler. Jeff, it's good to have you. And what's been driving this deal boom? Because there haven't been a lot of deals that really are top of mind. You know what I mean?
Yeah, and that's actually healthy. I would agree with you. From a cyclical standpoint, we're seeing a lot of deals in that $1 to $10 billion range. So they're big deals, but they're not the huge mega deals that tend to carry a lot of the headlines historically. And, you know, the fourth quarter is looking really good after what has been a really good year. And I really think kind of the punchline is in cyclical economics, just because you're hitting new record levels, doesn't mean the cycle's over. I think 2022 was looking like a very good year as well for the M&A boutiques.
How much upside could that be for Moelis and Evercore?
Well, you know, the catchy thing always becomes the cycle can turn quickly, so you never know how much better or worse necessarily it could get. But, I mean, if we just kind of hang in there with activity levels, I mean, you're talking for someone like Evercore, 25, 30% upside from here before I'd start looking and saying, okay, it's looking frothy relative to activity levels. And
you said that, you know, because this is global, about half of this is North America, but Europe has been a big contributor. And if that piece of this continues, you'd like Lazard?
Yeah, I mean, I think when you kind of look at where M&A activity's been, North America has really been where it's strongest. Things are getting a lot better in Europe, but Europe never really got back to before the financial crisis when it was like 35% of kind of global volumes. It's worked its way up from 20 to 25% now, but that's really, I think, the key area for global volumes to keep growing, and that plays right into Evercore's hands, or excuse me, right into Lazard's hands when it comes to who's the most kind of internationally exposed.
Well, it's an interesting point, though, about what's been going on with Europe, sort of more broadly speaking, in that environment for the last decade. You cover all the rest of, you know, a lot of the rest of the banks and financials as well. Why am I not seeing more about Goldman, Morgan, and those kinds of advisory firms here?
Well, I think you're seeing them. I mean, they're certainly getting on their deals, and they're still kind of leading the pack. It's just a relatively smaller business for them than necessarily for, say, an Evercore, where it's all of their business. But I think when I look at the kind of just the cyclical trends in capital markets, and this goes beyond M&A to things like equity underwriting, even sales and trading, I think 2022 is going to be a much better year than people are expecting. So, I mean, I think you look at a company like Goldman Sachs, that's a stock to own here, too. It's been very strong lately, but I think it's kind of discounting in a meaningful decline in activity levels next year, which may not materialize.
And I mentioned this a moment ago, but the fact that financials are having their best year in a decade when the 10-year is still at 1.4% is pretty notable. Would you say it's because of the steepness of the curve that they've done well, or is it time to just throw out the whole rates thing as an important component of their growth?
Well, it's an important component. Now, less so for the investment banks like a pure Goldman Sachs or an Evercore, more so for your traditional banks like a JP Morgan or a B of A. But I think the market is kind of pricing in that rates have to go up from here, and they may go up sooner than we expect. But I really do think, you know, the thing that's probably lacking from a traditional bank standpoint here is loan growth. We really need to see loan growth pick up. So I think the banks have done really well here, and I think they're kind of in a bit of a holding pattern until we got to get some confirmation that economic strength will kind of turn into loan growth and actually higher rates materializing. So we kind of, I think, had the first leg up, and it's been a pretty aggressive leg, but there's probably another leg to come.
So if I recast it this way to say you would stick with the advisory banks until we see an increase in loan demand, and then you might say to people broaden out to the rest of the bank sector, does that sound about right?
That sounds reasonable. I mean, definitely stick with the M&A boutiques and the investment banks. The only trouble, I think, with watching for loan growth is once it really starts showing up, you may be too late. So err on the side of being early and own the banks before it becomes obvious.